So this first lesson, if you want to call it a lesson, is going to be a bit more of just an introduction sort of thing as to what we're going to sort of cover and get through and lead into and all of that sort of stuff. But nonetheless, a necessary step. I'm just setting up a couple of things here before I share my screen. So we'll be starting out with the very, very basics. We're going to start the course assuming somebody's joining us that knows nothing at all about trading. That way, people can start from the basics and move their way up. If they think they're semi-skilled, they can skip the first couple of lessons and all of that. No, they can't. They can't skip any lessons. They need to learn it all. But honestly, I've done a few trading courses over the years, and as you well know, done lots of trading. So some of what, not what I'll be teaching straight up probably, but some of what I'll be teaching will be what I've been taught, what I've seen, but some of it will be my completely personal take on things, which probably will be different to what you would learn in other courses. So we'll see how that works out. I've got my own take on a few things, which probably fall into other classes of learning, but I haven't done that myself. So some of the terminology will be my own as well, I guess. So if it sounds like something else, then that's probably because it is as well. But I'm going to share my screen. And we're going to go through some very basics just to start with, what trading platforms and how we like to look at charts. So mostly we're going to look at the MetaTrader 4 platform, which is still the most popular one at the moment, which is what we're looking at here on the screen. And until things change, this will be the main one that probably most of us actually do our trading on. So I want to make sure people actually know, are sort of familiar with it. We'll do some lessons in the future, not too far in the future, which will be more intensive look at exactly how the MetaTrader 4 platform works and everything. But the first couple of lessons, I just want to familiarise everyone with it, just enough so that they know, you know, how to log into a trading. I guess before that, they'll have to learn how they go about opening a trading account with a broker and how to access that through this MetaTrader trading platform. So we'll go through that. And then there's another platform that is sort of something you really need to be familiar with, and this is TradingView. You can do your trading directly from here if you've got a specific type of trading account with brokers, with most or a fair few different brokers, which is very handy, and we'll probably get into that in the future. But for now, we'll just look at the MetaTrader 4 platform for actually doing the trading. And the reason we also want to look at TradingView is because they have a lot more tools and analysis type tools. They can draw and write on the screen in a lot more ways, and also a lot easier than with MetaTrader 4. So for now, what we're going to do is we'll do our analysis of the market and the charts on TradingView, so we know, you know, when and where and why we want to place a trade, and then we'll duck across to the MetaTrader 4 platform to actually place the trades. If you've got questions as we go along, Janet, anyone else that might happen to be on, just speak up, because That's what it's all about. It's not just me talking. We want to have a little bit of interaction so we get as much information as possible. And my way of explaining something may not work for you. If it doesn't, speak up. But just the reason I want to just have people a little familiar with how to have a trading account and how to place trades straight up is because in a couple of weeks' time, we're going to we're going to start our live trade calls. So they'll just be calls where people can join in on the calls and see us put our actual trading, the education that we're doing in these lessons, putting it into practice. So instead of just doing it as a theory thing, we will join a live call and, you'll see, to start with, it'll just be me, but it won't only just be me in the future, how we do our analysis of the chart, not just in theory, but in practice on a live up-to-date chart, and what we're looking for and when and why we place a trade. And that'll give people a couple of things there. Like I've seen people do some quite good trading courses and know the fundamentals of technical analysis and everything by the end of the course quite well, but still unsure about how to actually place a trade. So we're just going to go through that first. And with the live trade calls, people will be, until they're confident in their own ability to know exactly what to do and when to place a trade, they can simply just copy the trades that the guy running the call does. Of course, I would recommend people only do that on a demo account until they're a little more confident with that person's abilities as well. But if it's all working out well, they can just copy trades on a live account and hopefully make profit that way as well. So we need to know how to do that, place the trades themselves. But first of all, what you need to do before you've got any chance of placing a trade is you need to have a trading account with a broker. Now, there are a lot of different brokers out there, so I won't get into which ones you should or shouldn't use. And it will also depend on where you are in the world as to which one you want to use. But for example, here in Australia, a good broker that I've used for a lot of time and is a good high profile, quality, trustworthy broker is called Pepperstone. And that's just as it sounds, pepperstone.com. In the description of the video recording that I'll do of this, I'll put, just a link to Pepperstone. It's not an affiliate link or anything. It's just pepperstone.com, just so people have no trouble finding it. And so you just create an account with them. It's very easy. And then what you want to open up is a MetaTrader 4 trading account. There'll be a couple of other choices as well, but for the moment, if you're new, just go with the MetaTrader 4 account. You can either use a standard or a Razor account. That's the two types they have. Standard has, we'll get into it more, but for the moment, it really doesn't matter too much which one you have. One has lower commissions and higher spreads. The other one has tighter spreads and higher commissions. Sort of, in my opinion, for most types of trading, it's sort of 6 of one, half a dozen of the other, so it doesn't matter too much. All right, so once you've done that, you will end up with a MetaTrader 4 trading account with the broker, in this case Pepperstone, and they will also have, if you just give me a moment, they will also have a place, depending on your broker with Pepperstone or any other broker, they'll have a place where you can download the MetaTrader 4 platform. That'll either be called downloads or trading platform downloads or something like that. You just go to there and you want to select the MetaTrader 4 platform download. Usually there's either a Windows option or a Apple Mac type option. So just pick the one that suits you. And that'll just give you a file in your download. When you run that, it'll just create and open up the MetaTrader 4 platform like this. Then you need to actually log in to that trading account of yours. And to do that, you need to go to File up in the top left-hand corner and log into Trade Account, and you'll have this little pop-up. Now, when you create that trading account with the broker, you'll get an email with all the details. The details will be the trading account number, which will just be a number like that. Depending on the broker, it could be more or less digits. So that's your account number. And then you need to put in the password and also the server that it's on. Depending on your broker, they might have quite a lot of different servers. This one's Pepperstone Edge 09. So just select the one that you need there, and that'll be all in the email. You may have two passwords in your email. One will be the main password, which may be called the master password or the trading password or just password. And then there'll be another one, not always, but quite often, which will just be another password, which just allows people to view that trading. So it'll give you access to actually see what's going on, but not access to actually do any trading. And right at the moment, the term for that password is eluding me. But the one you need to use is the main password. And just click log in. If you log in successfully, you'll know for two reasons. One, this trade tab will become visible and the balance of your trading account will be there. When you create a trading account, if you're brand new, you probably want to start with a demo trading account. And so you can select what balance you want then. If you're not a brand new person, you probably already know how to open and log into a trading account. But you'll know you've logged in for two reasons. One, your balance will show up, and two, down in the right-hand corner, you'll have a speed in kilobytes. Just if you don't log in, it'll say something like invalid account, no connection, something like that. And then you're good to go. So you know you've logged in. Now, this is just a demo account of mine, and I do all my testing and things on here. To actually place a trade, don't worry about when and why and how you do it. The main way that we do it is just to click this little drop-down arrow, and you get this here. You can either place a sell order or a buy order, and you can select the size of the trade up here. So this is called your lot size, and that refers to the size of the trade. And we'll get into more detail in what size you should use on a certain account balance that it's at another lesson. But you can just click that to go up in lot size, or you can just type in one, whatever lot size you want there. You don't want 102 lots, so that's huge. And let's say I've done my analysis, which we'll get into a little bit in this lesson, but that'll be the focus of the rest of the lessons, or most of the other lessons. Let's say we thought the market was going to go down further, which that would mean we want to place a sell order. And so, we'd have our lot size needs to be 0. Whatever lot size we need. And then we just click on sell. Sell. Why isn't it? Well, I just realized it's a weekend, so I can't actually place a trade because with Forex, it's only 5 days a week. So the weekends, the markets are closed. But if I'd have done that and clicked sell, it would have put a dotted line across the screen. This little highlighted dotted line that's already there, that is the current market value. So, and each one of these little vertical lines, is the start of a new day. So 1, 2, 3, 4, 5 days ago, the value was right up here. So 5 days ago, the value of the euro against the US dollar was much higher, and it's come down, back up a little bit, and then hung around there. So when we actually place that trade by clicking either sell or buy, it'll put a dotted line across at the current market level. And over here, it will say sell 0.01 and it'll have a number of that trade. And then as the market goes down, that'll mean the trade will go into profit. So if you do a sell order, sometimes they call that a short, then if the market goes down, you're making money. If the market goes up, you're losing money. So that's something that a lot of brand new people just don't understand, is that you can make money if the value goes down and you can make money if the value goes up. Because we're basically, I definitely don't want to compare this to gambling or anything, but when you place a sell order, you're betting on the market going down. If you place a buy order, you're betting on the market going up. Yeah. The reason I don't want to compare it to betting is that the house always had a huge advantage with gambling, betting. You know, the bookie wins, the casino's always got the odds in their favour. And the whole idea of this course will be to show you how to push the odds of winning here in your favour. The very, very basics of trading is, as I said, the market can either go up or it can go down. It can also just sort of stay the same, but you don't win or lose. You don't make money or lose money if it stays the same. But so straight up, not quite, but just to keep this very basic, is if the market can go up or it can go down, then right there, you basically got a 50% chance of winning. It's actually not quite 50% chance of winning, but we'll get into that in more detail later. But my point is, if straight away with knowing nothing, if you tossed a coin and went buy if it was heads, tails if it was sell, or sell if it was tails, then you've got almost a 50% chance of winning straight up. So you don't need to learn very much in order to push those odds in your favour. And even though they call it technical analysis, it's not that technical. What I'm going to be teaching here isn't confusing. It's not rocket science. It's something that anybody can learn. And learning to trade isn't hard at all in theory. In practice, we have a lot of issues which have nothing to do with what we've learned and nothing to do with the market. It has all to do with our emotional attachment to our money. We don't like to lose it, and we really, really want to make some more. And that interferes with what we know we should do. And we will cover that probably in most lessons because that's the most vital part of trading there is. Controlling your emotions, trusting in the strategy you're using, sticking to that strategy no matter what, and risk management. They're the main parts of trading. Sure, you need to learn a bit of technical analysis and what you think the market's going to do, but I fully believe that's essentially secondary to controlling your emotions, sticking to your strategy, and having good risk management. All right, so that's just enough for the moment about the MetaTrader 4 platform. So hopefully you don't have any trouble understanding how to create a trading account with a broker and logging into it on the MetaTrader 4 platform. And you can download the MetaTrader 4 platform from your broker as well and log into it and get to this stage. That's no problem. If you haven't got to this stage yet and you're confused, even if you're just watching this video as a replay a long time down the track, just let me know if you're confused and we'll make sure you have no trouble setting up an account and getting to this stage. Now I'm just going to jump across to TradingView. And this is also just tradingview.com. And they will get you to create an account here. I will put a link to join TradingView in the comments of this video as well. And that will be my affiliate link for TradingView. Although most people are probably just going to use the free version of TradingView anyway. Until you get really serious about trading, I don't see any point to having the paid version. Paid version starts at around $15 a month, but the free version has everything you need for the moment. So don't go paying any money for it, at least not at this stage. All right, so let me just remove a few things from the screen. And I'm going to take you through just a couple of things. I'm just going to familiarise you with the TradingView platform itself. Just come to home here. All right, so we're just here, what they call the home page, I guess. But so there's no charts or anything up when you first log in, and you have to find them. So you've got all these different ones you can use, crypto, Forex, indices. We'll just stick with Forex for the moment. And you can just click on the main ones or scroll across until what you find what you want. Or up here in the search, you can just type in what it is you're looking for. So this is a trading pair, which is trading the euro, just the euro against the US dollar. And for example, if we wanted to trade the Australian dollar against the US dollar, this would be the pair we pick. And I'm just going to use the euro against the US dollar for the moment, which is the most traded pair, the most popular currencies. More money gets traded on this than any of the others. And you'll find you'll have a lot of different choices. If you can find one which is your broker, then use it. We'll pick the Pepperstone one for that reason. And we'll click Launch Chart. And then we get this nice chart. You can zoom in and zoom out just with these little things here. What we call this is the 1 hour time frame. So this chart is on the 1 hour time frame. And what that means is that every one of these vertical lines, red ones and green ones on the chart, are the price movement over a 1 hour period. So in 1 hour, it moved all this distance. On the next hour, it just moved the distance of this green one. We'll just zoom out a bit more so we can see it a bit clearer. These vertical lines are what we call candles. And we will have a lesson which will be all about candles, but for the moment, just so you understand this basic terminology, is that's a candle. This candle is going down, so it's what they call a bullish candle, which just simply means it's going down. And in this, you can change the colors and everything, but in this particular instance, all the bullish candles, all the ones that go down are red, and all the green ones are going up. So you can see the size of these candles varies greatly from these tiny little ones, which means the market barely moved for that whole hour, to big ones like this where it moved a long way in 1 hour. The main thick red part is what they call the main body of the candle, and the little thin fine pieces at the top and at the bottom, they're called the wicks. And as I said, we'll have a lesson on candles, but right at the top of the body of this candle is when the start of this hour started. That was the price of the market. And when it closed, it was at the bottom of the main body of the wick, the main body of the candle. But it did, at some stage during that hour, reach all the way up to the top of this wick, and it did reach all the way down to the bottom of this wick. This is where it opened, this is where it closed. That will just be terminologies that we'll use a fair bit in the future. All right, so as I said, we're on the 1 hour time frame now. If we click here where it says 1 hour, we can select what time frame we want. We'll go up to the 4 hour one. And so if you just double click anywhere, you can sort of drag your chart around. And over here, this is the price graph here. If you just double click and drag it up, you can sort of expand the chart up and down to make it sit and look exactly how you want it. So a few things we'll be looking at is, it's pretty obvious that on this 4-hour time frame, the price over here. So this, I need to go through to here. Okay, so this candle, the furthest one to the right, this is the current candle that we're on. Okay, so this is this red number here, this is the current price of the euro against the US dollar. So it's pretty easy to see that right over on the left, when the market was back here, it was higher, and it's generally gone downwards, and it's lower than it was. So this is what we would say, that the market is trending downwards. That's pretty easy to see. Sometimes it's not as easy to see as that, and we will go through rules so that we can determine precisely and more accurately whether the market's going down or up. As you can see, the market's always zigzagging up and down all the time, but sometimes it's going downwards for quite a long time, upwards for quite a long time, downwards, and then for a long time it just sits here and doesn't move greatly in either direction. And we'll get into the terminologies for all that as well. Just for now, I'm going to just touch on one of the main things that you need to understand with trading and doing analysis, and that is support and resistance. And I am just going to tell you the basics tonight. There are, in my opinion, a lot of different definitions to support and resistance. But what I am going to call support and resistance is, and we will do a lesson just on trading for you to understand all of these different technical analysis and drawing tools. But for now, I'm just going to draw a vertical line on the chart. And I'll just make that one blue, and I'll draw another line up here, and we'll make that one red. What I am going to call, I'm going to make my, just for the sake of argument at the moment, I'm going to make my blue lines are going to be what I call support. Okay, now, what my own personal definition of support is going to be a little different to some people's, because all I'm going to define support as is a place on the chart or a price on the chart where the market is more than likely going to stop going down and start going up. So for example, here the market's going down, 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 and it got to here and then it started going up. And we're going to look at why that happened. Okay, so in this particular instance, this is support. Not for any other reason except for the fact that that is where the market started going up. Okay, as I said, there are a lot of definitions for support. You will see that the market, sometimes you'll hear that the market needs to bounce off one level multiple times to make support and things like that. My support will not always be simply because that's the lowest point on the chart, like what I've got here. I'll put the support in at the low point, and I've put my resistance in as a high point, which in and of itself is support and resistance for one reason or another. But I will also have other definitions of support. I may end up with, a line for example, I might end up with a line that is just here. Okay, and this here could also be, make this a blue line, even though I've got this line here right in the middle of everything. It is also a place where the markets stopped going down and bounced up. Not because it's a low point on the chart like this one, which is more traditional type support, but simply because, and we're not going to get in at the moment, but there is another reason entirely why the market had a high chance of reversing and going up here. And identifying that, or identifying this point here, is the whole basis behind trading theory, technical analysis. This is the only issue with the free version, is that you keep getting those ads. Okay, so we just really, as a trader, all we need to do is, if we can accurately identify this point right here and place a buy order, the market goes up and we make money. If we can accurately determine that the market was going to bounce right here and start going up, same thing, we'd place a buy order, we'd make money. And likewise, if we identified the top here, we would place a sell order and we would make money as it goes down. So, as I said, tonight was just going to be about like an introduction to what we're going to accomplish, which, as I said, was just going to make sure people understood how to get involved in trading by having a broker account and logging into that trading account and knowing how to place trades in case they want to jump in our live trade calls and take advantage of that. And then I've just sort of touched on what we're trying to do as a trader. Because I know when I first started trading, I was trading for a while. I didn't even know what support and resistance was. And that's probably the basic fundamentals of it all. So as I said, for me, support is just a place where the market's going to stop and is going to start going up. Okay, that's what support is for me, where the market starts to go up. Maybe it was already going up and stopped for a while. So maybe it went up and then went sideways for a while and then started going up for some reason, which we'll learn how to identify. That would also be called support in my book. Other people might give it different definitions, but for me, support is where the market's most likely going to go up. So you just need to identify support, place a buy order, market goes up, happy days. And resistance is simply the opposite. It's a place for one reason or another where the market's most likely going to start going down. Now,
and Liz, do you always do it on a daily time frame?
No, not at all.
Okay, all right.
I'll touch on that just before we finish off this lesson as well. Resistance, just so you understand, resistance is always higher on the chart than the current market value. And support is always lower than the current market value. That's the only difference between the two, really. One means you're going to go up, one means it's going to go down. Now, with what you just said, do we always do it on the daily? There are so many different trading strategies out there. It's obviously not funny. A good deal of them actually work. And we'll get into some of them at some stage. But this won't suit every trading strategy or anything. But what is quite good to understand is what's happening on the daily time frame, on the 4-hour time frame, on the 1-hour time frame, the 15-minute time frame, so that you can use all of that information to make a more accurate decision. So generally, the higher time frames are more accurate as far as for the moment, as far as support and resistance goes. The higher time frames are more accurate. The trends are also more accurate. A lot of things are more accurate because you're looking at a larger amount of time. But because, so if we have a look at, you can just trade on the daily as well. But if you placed a trade on this candle here and you did a sell order and you wanted to take profit down here, if we have a look at the candles, that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Where's my cursor? So from here, give me a second. If we place a trade here, if we place, I'll just do it simply. If we placed a trade here, remembering that every one of these candles is 1 day, then that's 10, 20, 30, 40, 50 days until the market. So this one trade would really sort of take 50 days to play out. People do trade like that. Those long-term trading strategies are what they call swing trading. They take a long time to play out. But what we'll probably mostly focus on is trying to identify on the daily. This is a good strategy in my opinion. If you can identify the top of the market here on the daily, we're looking at a long way down to here. Okay, that doesn't mean we have to wait 50 days to make profit. That just means that there is a long way down here where the market's mostly going down. And then if we just let me find, I don't have my chart set up very well just yet. But where were we? So I'm just going to put that vertical line where we identified the top of the market as. And then I'm going to go down to the 4-hour time frame. And I'll just go back to where that was. Okay, so there's our vertical line. This is where we identified the top of the market as. And if we have a look on the 4-hour time frame, the market's going down for a long time, still the same as well. So now the top's still the same and we're trading down. And then on the 1-hour time frame, where's our thing? So sort of my point is that we identified this as the top of the market on the daily time frame, which looked like just one candle that quickly spiked up. But now if we are down on the 1-hour time frame, we can see that one candle is spread out. Now that one daily candle is all of these candles combined. And if we break it down into the 1-hour candles, we can see a lot more of the finer movements. So on the daily, it looked like it was just one big drop all the way down, which was going to take 50 days to play out. which is good to know that the market could go down and down and down for a long time. But then we could come down to the 1 hour time frame, and we could, we could essentially place a sell order here and take profit here, identify the top here again, do a sell order, take profit down here, identify the top of the market again, place an order, take a sell. So instead of just having one trade that takes 50 days to play out, we could have multiple smaller ones that play out really quickly, and take profit here, and then we don't trade at all until the market's back up here, and then take profit as the market goes down. As the market goes up, we don't trade. As the market goes down, we do trade and take profit. The reason we're not trading as the market goes up is because we've already identified on the higher time frame that the market's most likely going to continue down for a fair way.
Mm.
And so we'll get into all that a lot more in more detail, because
there's
a lot to do with it. But the real difference between the higher time frames and the lower time frames is just what it sounds like. Each candle at the moment is 1 hour. When we jump right down to a 5-minute time frame, I can't even find the chart. Then every one of these candles is only 5 minutes long.
Mm.
So you could identify the bottom of the market here, place a buy order, and in less than what would that be, 3, 4, 5, 10, in half an hour to an hour, that trade could be finished, and we could have made good profit as that moved up. And then we'll pick the bottom here again, do a trade, take profit here. So the shorter time frames, everything plays out a lot quicker. And I can't really say too much more without getting into the finer details of various different strategies. But yeah, I think most traders that know what they're doing, they don't just trade the daily, or they don't just trade the 1 minute or the 5 minute. They may look at the lower time frames to find a more precise entry. Like, let me just give one more example. All right, so let's just put a vertical line here again. Okay, so we may have identified, this, which one? This candle here has the highest point of the market, and we're expecting it to go down for whatever reason. And that's on the 1 hour time frame, so we can see that that's the market's going to go down there. But where exactly should we place the trade? We might say that, all right, looks like the market's going to go down from there. But if we jump right down to the 1 minute, then we can see a lot more finer detail, so to speak. So instead of it just looking like one quick candle going up, we can now see that just in that one, so like a 1 hour candle is the same as 60 of these 1 minute candles.
Yeah.
We thought that this was going to be the top of the market here, but it actually went quite a bit higher over here. And also, without getting into the whole strategy of everything, we might have only decided to place a sell order here, but there's a very good reason why we should have waited until here. The more accurately you can pick your entry, the less risk there will be, and the more potential profit. And we'll get into that very, very soon, because if you place a trade, there's two things that you're going to want to do straight away. So if we decided to place a if we saw the market coming up, like just look at it here, don't take this as any great trading strategy or knowledge, but for example, we saw the market going up here and then we saw it starting to come down. So we might have decided that meant the market was going to continue down. So we would place a sell order here. What we would also need to do is place what's called a stop loss. Okay, which means if the market doesn't continue to go down and it comes up, when it hits our stop loss, we take a loss, but it's there to stop us taking a bigger loss. And that's, just the very basics of risk management. You can't just place a trade and leave it, because if you don't place a stop loss and the market continues to go against you, you can lose all of the money you have. Simple as that. But for example, here we decided to place a sell order right here, and we might have placed a stop loss here because it was just above here, and it just went into a bit of profit, and then it would have come up and we would have taken a loss. Whereas if we waited for a more accurate entry, which would have been up here, and we put, if we placed our trade right here and put our stop loss above this point, then we've picked the top of the market much more accurately, and the market continues to go a long way down and we'd make a lot of money. So if we weren't looking on the smaller time frames, we wouldn't be able to pick this position as accurately, and we could end up trading here and taking a loss. But by coming down to the smaller time frames, and it's never as easy, I'm probably making it sound, but we can then, in theory, pick the top of the market much more accurately, meaning that instead of taking that loss, we just keep taking profit and the market just keeps going down. So we would just keep making profit for a long time down. Easy in theory, not as easy in practice, but that's just sort of to answer your question about time frames. So
Thank you.
Higher time frames are doing, but it's more accurate. You can pick your entry more accurately on the lower time frames. And a great deal of the strategies we'll go through will be based around that. Anyway, awesome. So that'll be it for tonight, guys.
Thank you.
And next week, I'll put in our chat group exactly what we're going to cover next week, because I'll be more organised next week. But we'll go through ways of identifying, support and resistance. We'll also talk about market structure and working out which way the market's trending. A couple of the most basic but most important things you need to know. And from there, we'll sort of delve into more serious strategies, and patience is a good thing, because, we might, the market, like, this is what I mean by patience. We might have done some analysis on the chart on the higher time frames and determined that we thought the market would come all the way up to this line before going down. If we don't have patience, we watch it almost make it and start going down, so we jump in, do a trade, but then it goes up further. And inexperienced traders do this all the time. They think, oh, that's so close to what I thought it would do. That's probably as close as it's going to get. So you jump in here and it looks good for a little while, but then it does eventually come all the way back to where you were. And which means you've wasted that time, possibly taken a loss, but definitely, gone into more drawdown before you had. And so up here, you could have a stop loss right here. If you put a trade in here, your stop loss still needs to be here to be safe, so that you don't hit it and take a loss. So, the further away your stop loss is, the smaller your trade needs to be for the same amount of risk. So if you can really accurately identify the best place to enter the market, you can have a much larger trade with only the same risk, because it's more accurate. So, so if you placed a trade here, you understand how that if I placed the trade right here, if we decided to place the trade right there, in order for us to not hit our stop loss and not take a loss, we would need our stop loss to be above this point here. Any closer and we would hit it and we'd take a loss. So that needs to be there. Whereas if we placed our trade, right here, the stop loss can still be in the same place, but it's much closer. So we could have this trade here could be twice as large as this one here and still only risk the same amount of money. But we would make twice as much for however much distance the market moves. So if the market moved down here all the way to here before we took profit, we might make $100 if we place the trade here. But if we place the trade here, we'd be able to take $200 profit here. That's the difference between being able to have a very accurate entry point. There's nothing wrong with placing your trade here. As long as you had your stop loss far enough away, you would still, you'd go into a bit of drawdown and then, you'd take good profit. But you can take much better profit by picking this point and risk a lot less. Anyway, that's all very sort of broad spectrum, nothing very specific there, but we'll go into in the next few lessons, how do you pick this spot over this spot?
Yeah, that's yeah. Yeah.
I just wanted to go through so people understood, why it's much better to pick this spot than this one. I mean, it's probably obvious to most people, but it can make a big difference. If you take $200 profit every trade instead of $100 profit every trade, you're obviously making twice as much money, but it also means that you can lose twice as many trades before you actually go behind. If you're losing $100 every trade, and this trade here you're only making $100, then you need to win 51% of your trades to be in profit. Whereas if you're placing your trade here and losing 100, and if you lose it's $100, but if you win you're making $200, that means you need to lose 2 trades for every one you win in order to break even, which means you only need to win 33% or 34% of your trades to be profitable.
Yeah.
So that's a really good point for people to remember as well, is that if you risk $100 to make $100, you need to win 50% of your trades to break even. If you risk $100 to make $200 every trade, then you only need to win. Could I do those calculations right? You only need to win 33% of your trades in order to be profitable, in order to break even. If you risk $50 to make 200, it means you've only got to win 25% of your trades to be profitable. So and this is something new people probably never even thought about, is that you could lose 3 out of every 4 trades and still potentially make profit in the end, average profit.
Yeah.
So you definitely don't have to win all of your trades or even half of your trades in order to come out in front. And that'll be a whole lesson, or probably several lessons on risk management and risk to reward ratios and all that. Right, that should do to whet everyone's appetite. I'll leave it to you until next Saturday.
Yep, sounds like a plan.
Have a good night.
All right, thank you.